Dividend stock investors might be looking at Verizon and AT&T and looking at the dividend yields of 6.3% and 4.7% respectively, and really getting interested in these two dividend stocks. But which one is the better dividend stock to buy for 2025? That's the question I'm going to answer in this video, comparing these two dividend stocks across several important metrics for dividend stock investors, including revenue, dividend yield, cash flow, and valuation, to determine which one would make a better investment for 2025. And of course, beyond, right? You're buying it for 2025, but I'm speaking more for dividend investors that are looking for longer term investment, which is the most case for dividend investors, right? Most dividend stock investors are not looking to get in and out of a stock real quickly. So buying in 2025 and holding for the longer term, I'm going to answer which one I think is better.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, starting with the revenue growth comparison, I don't think any dividend stock investor should expect revenue growth from Verizon or AT&T, at least not anything above low single digits. These are mature companies operating in mature markets that are saturated. There are very few new smartphone customers entering the market, and those that are entering are offset by those that are leaving. So you have a market that's primarily saturated for Verizon and AT&T. That being said, they have a few opportunities for incremental growth by increasing the data they might be selling to customers, increasing the speed at which customers replace their smartphone and upgrade their smartphone. They might be able to generate some incremental revenue growth by adding a device or two, right? Instead of only having a smartphone on your monthly plan, maybe you add the iPad, maybe you add the smartwatch. And so they have little ways to generate incremental revenue at the margins, but nothing above low single digits. And if you get that, you should be happy if the companies can generate 3-4% revenue growth over the next several years. I'm certainly not expecting that to happen for these two companies, but that's okay. They don't need to generate very strong revenue growth. I do think they need to generate positive growth, at least 1 to 2%, to maintain earnings per share, to maintain cash flow. However, that may or may not happen for these two. All right, of course, the dividend yield, the one metric that many dividend stock investors are attracted to. Verizon has the better dividend yield at 6.3% compared to 4.7% for AT&T. But I will caution at placing too much importance on the dividend yield, because these companies, when you're investing in a dividend stock, you get two sources of return. You get the dividend yield, which is one source of return, and you get the capital gain yield, which is the change in the stock price. And the change in the stock price can be negative and it can be positive. Sometimes the negative of the change in stock price offsets your gain in your dividend. So your total wealth actually declines. And so it's important to look beyond just the dividend yield. It is an important metric, I agree, but you've got to look beyond that to also secure the fact that the capital gain, the change in the stock price, can be negative. And so you want to look at the other metrics: revenue growth, cash flow, profitability, valuation, to determine if there's a chance that the stock price can offset your gains in dividend income. Also, you want to look at sustainability of the dividend, and the way to do that is to consider the payout ratio. Here's why that's important. The dividend payout ratio measures the percentage of earnings per share that's paid out in dividends. It's a measure of how sustainable dividends are. For instance, in this first example here, you have a dividend per share of $1.75 and earnings per share of $2. That means that's a dividend payout ratio of 88%. That's relatively high. That means if earnings per share were to decline below $1.75, that company would be paying more in dividends than it's bringing in earnings. And just like a household that cannot spend more than it brings in earnings for the long term, in the same way, a business cannot pay dividends more than it brings in earnings per share for the long term. Sure, in the short term, it can borrow money to pay the dividend, but eventually it will exhaust its borrowing capacity. Additionally, it can pay dividends out of its savings, but eventually it will run out of savings. That's why, in the long term, if you want sustainable dividends, you want a dividend per share that's below earnings per share at a comfortable level, like the second example here, where you had a dividend per share of $2.75 and earnings per share of $10. That's a dividend payout ratio of 27.5%. For passive income investors, what this means is that the dividend is not only sustainable, because even a drop in earnings per share of 50% would still mean that the dividend per share is below the earnings per share. But it also suggests that there is room for this company to increase the dividend payment. So investing in this company brings with it the probability that the dividend per share will rise over the next several years. And finally, the last example, where we have dividend per share of $3.50 and earnings per share of $1.45, that's a dividend payout ratio of 241%. The dividend payout is more than 2 times the earnings per share. When you see a situation like this, it's likely that this company is going to pause or reduce its dividend payment. That's very likely to happen in the near term, unless the company can expand its earnings per share in a relatively short amount of time. So now that you understand the importance of this metric, you can see Verizon at 114% is not sustainable at these levels. AT&T at 90% is really high, but it's more sustainable than Verizon. Now, when we compare these two on cash flow from operations to sales, AT&T has taken the lead here at 31% compared to Verizon at 26%. These companies generate strong cash flow from operations to sales. This helps them pay down debt and pay their costs, which debt is a factor for these two. These are the most indebted companies in the United States, two of the most indebted companies in the United States, with over $100 billion each in debt. However, that's an opportunity over the near term because interest rates are higher. Verizon and AT&T have both signaled, and they have been doing, paying down debt. And when they pay down debt, that reduces their interest expense, which will leave more cash to pay down even more debt. And so they can continue on this positive virtuous cycle, paying down this debt as it comes due instead of refinancing to lower the interest expense. Companies do this strategically when interest rates are higher, and this is an opportunity for these two to facilitate drawdowns in debt. And lastly, I want to compare these two on valuation. And Verizon and AT&T are trading at relatively cheap valuations, but it's because these are no growth companies or zero or very low growth companies, which investors are not very attracted to, because if you're not growing, you're going backwards. And that's a big risk for investors, as these two are losing market share and substitutes are coming in and potentially taking market share. And so it's risky when you're not growing your business. Verizon is trading at a price to sales of 12.9, while AT&T is trading at a price to free cash flow. I should have said price to free cash flow of 8.35. So AT&T is trading at a fraction of the price of Verizon. AT&T is 2/3 the price of Verizon. I didn't see anything that justifies this much of a premium for Verizon stock. So if I was to pick between these two dividend stocks, I would pick AT&T for 2025 and beyond. If you liked the video you just saw and you want to see more just like it, please subscribe to the channel. I can't keep this channel free without the support of viewers like you. And if you're already subscribed, thank you, and I appreciate your support.